welcome to Bloomberg Quint Live. You're watching Trend Spotting. I am Shraddha Babla. Good morning, Agam.
Good morning, Shraddha. I'm Agam Akil, and in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and their implications on investors. First, the headlines. Markets trade with strong gains ahead of the RBI policy. Both benchmark indices trade with gains of over 1% each, and the Nifty trades steady above the mark of 10,250. Broader markets in line. And metal stocks are the top gainers in trade today after the US and China say they are open to renegotiate trade ties with each other. And the RBI's Monetary Policy Committee is likely to maintain a status quo today, shows a Bloomberg survey of 26 economists. And banks get a temporary reprieve from the RBI, are allowed to provide for a smaller amount of accounting already at the NCLT, but only in the fourth quarter of FY18.
Right, the Indian markets continue to track the global rally as trade war concerns ease. So the benchmark Nifty index is holding on to gains up about 1.3%. Sensex trading or advancing by over 400 points. There are just 3 losers and 47 gainers on the Nifty index, and I haven't seen that sort of a trend in a long while for now. India VIX has dived about 8%, and all sectoral indices are trading with gains. Metal stocks is what I want to highlight. They're seeing a sharp recovery. You see the names or the likes of Hindalco, JSPL, Vedanta, all of them are seeing strength of over 5%. And the Nifty PSU Bank Index, that has advanced by about 1.5% on the news of provisioning relief for banks on NCLT exposures, and we will talk more about that on the course of this show. But what is also interesting is that barring City Union Bank, all banking stocks are trading in the green. That's the one lone loser. Everything else is trading in the green. Agam, what else are you spotting?
Well, I am spotting some pressure in something like a PVR because I understand that the High Court has ordered the exhibitionists to curtail costs of the foods and beverages. It did see quite a deep drop earlier in trade, but it has recovered from day's lows. It's down only 1.3%, not much to speak for. And of course, you already mentioned a host of all the other metal companies, so I'm just going to talk about the advanced decline ratio in general. And we've seen a little bit of a reversal from what we saw yesterday in terms of the first half of the session. Of course, right now that advanced decline ratio is very, very wide, and as you can see, about nearly 14 stocks for, I would say, 14 stocks that are advancing in comparison to 2 stocks which are declining. So on the whole, the market's looking good, and of course the benchmark industry is showing a lot of strength. Shraddha.
All right, let's tell our viewers what we have lined up on Trend Spotting today. First, will the RBI Monetary Policy Committee maintain a status quo on today's policy meet? We will get an Economist view from Aditi Nayar of ICRA. And what impact is the nutrient-based subsidy likely to have on the fertiliser sector, which has been buzzing? We will get an analyst view from Rohan Gupta of Edelweiss Securities. Well, the big event domestically today is the monetary policy announcement today. Not that the 6 members of the committee are expected to tinker with the key dates, but Ira Duggal has wrapped up all the factors that are at play this time in this report.
The general expectation is that this will be a bit of a non-event in terms of rate moves. So the Bloomberg poll that we've seen says that everyone expects rates to remain unchanged at 6%. That would be no surprise given the fact that the last reading on consumer price inflation was actually softer than expected. So even those who had started to talk about rate hikes have quietened down a little bit. But this is an interesting juncture for monetary policy. So I'm going to spend a couple of minutes talking about the inflation scenario. In particular, if you look at the inflation picture under the MPC regime, which is now more than a year old, they've actually had a fairly decent run now with inflation staying within the comfort band of 2 to 6%. It hasn't flattened out near that center point of 4%, which is now the endeavor. But in terms of just the comfort band between 2 and 6%, inflation has stayed within that. Actually, if you lengthen out that chart and look at inflation on a longer period, you probably come away with a little bit more comfort, because remember, as recently as 2013, you were seeing consumer price inflation numbers in the range of 11%, double-digit inflation. Well, we are well away from that. So while we are talking about upside risk to inflation, remember that those upside risks are from 4% or perhaps 5%, certainly not the kind of numbers that we had seen in relatively recent years. So we have come a long way in terms of bringing down the level of inflation, which has then led to the question as to whether there's a structural shift in the inflation scenario in India or not, or has this been entirely because of low global crude oil prices or a change in the government's MSP policy, etc.? Well, there are two views on that, and I'm not going to go into deep theory on both the views, but the dovish view is coming from Ravindra Dholakia, who, apart from what he has said in Monetary Policy Committee meetings, wrote a paper in the EPW in March where he argued that the drivers of inflation in the current scenario are different, and he seemed to be arguing that even inflation expectations have moderated since the flexible inflation targeting regime was brought in. Michael Patra, on the other hand, continues to argue that it's time to start hiking rates. He believes that the RBI and the MPC may be behind the curve, and he feels that all major indicators of inflation are now converging to above 5%. You can read more about those two ends of the inflation debate on BloombergQuint.com, but it is that debate that the MPC has to resolve as it looks ahead to monetary policy in the new financial year, not just in the current time. Of course, apart from monetary policy, there are two important things to watch out for. One is what they say on liquidity. The liquidity will tighten as the year goes along. Already it has been moving between surplus and deficit. Does the RBI come and give in a little bit more comfort about structural liquidity that it will provide as and when required? That will be watched out for. And the last debate is on the FI limit in government bonds and perhaps even corporate bonds. The limits are more or less taken up. The debate is as to whether the RBI continues to increase the limit. Remember, in a staggered fashion, we've gone up to 5% of outstanding bonds on government bonds. The RBI will perhaps choose to continue that staggered increase, but the question is, what is the terminal rate at which they want to leave that percentage of holding in the government bond side? On the corporate bond side, you have not seen an increase in the limit all the way since 2013. So lots of arguments that it's about time they did that.
All right, thanks to Ira for summing all of that up for us. But let's also get an economist view on this from Aditi Nayar, the principal economist at ICRA. Good morning, Aditi, and thank you for joining us. A no change in interest rates is clearly a given at this point in time, but do you expect a change in stance or at least some sort of an acknowledgement from the MPC, given that the inflation of late has been trending lower than their expectations? And again, do you see any sort of upsides to this inflation given how the oil prices have seen a renewed rise and then currency also has depreciated? What's your outlook on that?
Thanks, Shraddha. Certainly, we are also expecting a status quo in today's policy as far as the repo rate is concerned, and we're not really expecting there to be a change in the stance either in today's policy. Now, as Ira mentioned, we have this debate between, the dovish inflation outlook that's being forecasted by one MPC member and another MPC member that thinks that, inflation is trending structurally higher. But my best guess is that the resolution of that debate is going to be that the other four MPC members are possibly going to want to wait for additional data before taking any change in the stance. So we're going to remain on a wait and watch kind of outlook. And particularly given the kind of volatility that we're seeing in the monthly inflation rate, which went from 5.1% in January to 4.4% in February, it's really hard to take a call on where inflation will trend 6 or 12 months ahead, particularly when we know that there are these clear known unknowns that are going to influence the policy, the inflation trajectory, particularly after June. One being the monsoon. We've only got one early indication from SkyMed so far that the monsoon is going to be normal. We're going to be looking forward to the IMD's first projection as well to get a better sense of how the monsoon will be distributed. And certainly in the current scenario, having a normally distributed monsoon is very important because reservoir levels are trending quite low. In March, the 2018, the reservoir levels are closer to where they were in April 2017. So 4 weeks ahead of time, we are seeing a drop in reservoir levels because after the last monsoon, precipitation levels have been very low across most of the country. So big, important factor in terms of how the monsoon will play out. And also the MSP proposal that was made in the budget, how will that really be fleshed out? What will be the dynamics of that are going to crucially affect the food inflation trajectory, and we're not going to know those details possibly for a few more months. So beyond June, I think there is some lack of clarity on which way inflation inflation is going to trend. From the current data that we have, we think that the peak will be in June, and then a base effect should at least lead to inflation softening after that. But MSP on monsoon and of course crude oil prices will be very important factors that will influence the trajectory after that. So as of now, even in terms of the stance, we are not expecting a change, and the tone should still be on a wait and watch. Other important thing would be in terms of growth. Last time the MPC had sounded quite dovish on the growth side, wanting to nurture the economic recovery. So how the language changes on that front is something we'll be looking at very carefully. And liquidity, now that we're in April and the busy season is behind us, what are the kind of outlook that the MPC projects on the liquidity side, and also what the RBI does for the FPI limits in GSEC. These will be some of the major things that we'll be looking for in this policy.
Right. So Aditi, there are also some reports of the Finance Ministry proposing to raise the FPI limits in Indian government bonds. I want to understand from you, is there a significant appetite from Indian bonds, given that there has been a significant rise in volatility, and of course, like you said, there's a lot of uncertainty with respect to how those inflation rates, all those fiscal risks and the higher H2 borrowing program for the government, and how that will impact yields in the second half. So what is the kind of appetite that FPIs could have if such a move was announced by the RBI? And again, could that really make a distinctive difference as far to the bond yields?
Absolutely. See, our view is that if the FPI limit is hiked, then we are going to get an initial positive reaction, and bond yields could ease further from the levels that they're at right now. So that's something that we think would, in conjunction with the borrowing program for H1 that has been announced, and the 4-quarter provisioning that for the MTM losses that banks have been allowed as well. These three factors are something that at least in Q1 will keep bond yields on the lower side. So for the 10-year GSEC, we expect that it will trade between 720 and 740 in Q1. But by the time we get into Q2, a lot of the other factors, on which we don't have so much clarity right now, will start to become more important. Not only the inflation outlook and the likely rate action, if any, in H2. Also what happens as far as Government of India's fiscal trends are concerned. We'll start to get some sense of how the fisc is evolving by late Q2. We'll know how the GST collections are trending after the e-way bill. Also how the dividends, particularly the surplus from the RBI, we would know by July, August the amount of that, whether disinvestment has kicked off successfully or not. And on the expenditure side, not only the MSP but even otherwise, is there a front loading in expenditure? So fiscal trends will be a lot clearer by Q2, and we'll start to obviously have a sense of whether the H2 borrowing program will exceed what currently has been projected. With all of this, as we move into Q3, I think global trends are also going to end up being very important. Right now, our view is that the US 10-year treasury yield is taking into account at least 2 more rate hikes by the Fed in 2018. But as we go closer to 2019, the yield will start to price in what is the expected action in 2019 as well. And therefore we do expect that to start rising, and that is again something that will either push up yields in emerging market countries, or we'll see that the appetite starts waning. So the FPI limit immediately, yes, we do think that that will have a beneficial impact on bond yields, but ultimately as we go closer towards H2, the appetite of the FPIs, not only in the global scenario but also specifically looking at greater clarity as far as the domestic risks are concerned, that will become more important. So as of now, we do see yields starting to rise in Q2 itself to maybe 730 to 760 for the 10-year, and then H2 yields would be crucially impacted by what is the borrowing program that gets announced by the Government of India.
Okay, Aditi, we leave it at that. Thanks for joining us and giving us your outlook as well as what we can expect from the RBI's monetary policy. Of course, we will have more updates coming in the latter half of the session with respect to the policy coming in. But we'll move on and address, the agri-facing sector, because we have seen Skymet, predict a normal monsoon, and we actually want to understand what the implications are for a lot of these agrochemicals as well as perhaps fertilizer companies. So for that, we're in conversation with Rohan Gupta. He's the Associate Director for Institutional Equities at Edelweiss. Good morning, Rohan. Thanks for joining us. Rohan, let me just start off with the fact that we have had Skymet make the prediction of normal monsoons. And I reckon that normal monsoons is, of course, positive news for the agricultural industry. My question really was right now is what is the capacity of the farmers, in terms of how acreage has panned out and the kind of income that they have had right now to go ahead and buy fertilizers and crop protection?
Good morning, Agam. Yeah, as you rightly said, that Skymet has given it's a positive commentary about the monsoon, but that is a general trend that most of these monsoon forecasting agencies, including IMD and Skymet, they generally come with a positive commentary at the starting of the monsoon. But what we need to see that how the distribution of monsoon pans out when the season evolves. So we need to really see that, number one. Second, as you rightly said, that when farmers enter in the sowing season, like Kharif crop has just to start, the cash position of the farmers really matters a lot, but also matters that their predictability of the farm produce prices or the crop prices, what they are going to get of the produce prices. And on that front, I believe that this year is likely to be better than the last year. Some of the crops like cotton and paddy, we are going to see better prices than what we have seen in last year. Also in some of the horticulture crops, which has been affected last year by either demand or a pre-GST scenario, there we are going to see better prices across the crop. So in terms of pricing outlook, I see that it is much better than the last year. This year has not been that great from the farmers' perspective, and Rabi crop has also not been something very, very encouraging for the farmers. But I believe that the higher produce prices will be something which will be giving incentive to the farmers to spend on agri input, and that's where our positive commentary is about agri input companies and for the season going ahead.
Okay. Rohan, I understand that you're saying that the prospects for some of these agrochemical companies look good as far as FY19 is concerned, but could the uptick in the global raw material prices really dampen the margin outlook at least and the bottom line prospects for some of these companies?
Sure, Shraddha, you are right. In terms of that agri input prices, especially some chemical prices, we have seen that China has seen some chemical prices going up, and the impact of that has also to be seen in agri input prices as well. But if the demand scenario is good, then these companies will be in position to pass on the prices. And we have seen, especially in a generic product category, we have seen that prices have already started going up from 5% to 20%, depending on the product category. But with the pickup in demand, we should be able to see that companies will be in position to pass on the prices and holding on their margins.
Right, Rohan. So I believe that you do like something like Dhanuka Agritech from the crop protection industry and Deepak Fertilizers in the fertilizer space. Can you take us through the reasons behind your preference towards these stocks?
Sure. So we have seen a significant correction in the stock price of Dhanuka Agritech in a recent weakness, and the company's performance has also not been that great in last couple of quarters, and that is also coming from the overall weakness in agrochemical industry. We see that coming quarter, I mean Q4 and more importantly first half of next year, we should be able to see the benefit in terms of their pickup in a revenue growth for company. We expect company to easily clock a revenue growth of almost 12 to 15% revenue growth. If we are expecting a normal monsoon, it can be even higher. and with the company holding on our margins, we should be able to see a 20% plus PAT growth for a company like Dhanuka. And I believe that the new product launches, the new product which they have launched last year, which could not have done so well for the company because of the weak monsoon scenario, should be able to help the company in this year, and that's what our optimism in the company is driven from there. Deepak Fertilizer company has last year commissioned or increased their capacity of complex fertilizers last year significantly, and this year we are going to see a significant volume ramp up for the company that will be driving company's fertilizer earnings. On chemicals, Deepak Fertilizer also have a wide portfolio of chemical, and more than 60% of its profitability is going to be driven by its chemical portfolio. There we see that pickup in ammonium nitrate business and other chemicals is going to drive the earnings growth for the company. So that's why we are pretty positive on Deepak Fertilizer for the current year.
All right, thank you very much for giving us your perspective and the outlook as far as agri inputs are concerned, Rohan. That was the view coming in from Rohan Gupta of Edelweiss. So we've spoken about, since today is the RBI monetary policy day, we've addressed agriculture and the impact of MSPs, and let's also talk about banking sector, because that's another aspect that the RBI is expected to touch upon, the asset quality, of course. But there is another story which has popped up today where the RBI has gone ahead and given banks a fresh breather, letting them provide a lesser amount for accounts that are already in the NCLT. And that's according to a Bloomberg Quint report that was filed by its reporter Aditi Nayar. Let's get a banker's view on this, and joining us on the phone line is Pawan Kumar Bajaj, the Managing Director at United Bank of India. Good morning, sir, and thank you for joining us. So what we have heard from our sources is that banks can now make a lower 40% provision on the secured loans, loan exposure to IBC cases for the March quarter as compared to the earlier requirement of 50%. So have you received any such communication from the RBI?
Good morning. Yes, we have received communication from the RBI. Instead of earlier, whatever two list of RBI, 40 cases were referred to NCLT, wherein they told us to provide 50% provisioning in case of secured advances and 100% in case of unsecured advances. So now they have told us to do only 40%. So that is only for this March quarter. Some means forbearance has been given, but the same amount you have to do it in the next quarter, June. And what I feel reason is because in most of first list cases, those resolution will take place in this current quarter. So that will basically means where banks have already provided sufficient amount. So that will give a leeway to the bank not to provide right now. So that will take care of the means capital requirement by various banks, and the ratio would be good.
So hasn't this decision of the RBI come a little late? So what I'm trying to understand is how much of a positive impact would that 10% savings on provisions have with respect to the write back on a Q4 numbers? If the banks decide to go ahead and implement or use this relief measure, and if you do write back some amount in Q4, again it would mean higher provisions for the June quarter then.
See, what you are telling means the amount differs from bank to bank, because I don't have the exact figure, and it also depends on how much earlier banks have provided in those kind of accounts. But if you say yes, definitely means there is a right back to various banks. But the reason I have already told, because in June again same has to be provided, whatever you are writing back right now. But in many cases of the first list, resolution will take place and bank gets the money. So that whatever write back again means provisioning again in June, that will be taken care by the settlement process.
Okay. So what is your current exposure to the combined exposure to the two lists of the IBC cases and the provisions that you've made towards them in the third quarter, and how much was pending to be made in the fourth quarter?
Actually, it was pending was only very small amount, around 250 crores. So that is now not required, and there is a write back of almost 80 crores. So we are getting a benefit of roughly 330 crores.
Okay, that's if you go ahead and use this provision measure that has been given. Sir, also trying to understand just how bad the NPA pain, is likely to look for, if not just your individual bank, but for banks in general in the fourth quarter, because especially on account of RBI's new NPA rules that were released in February, the RBI has also taken steps and allowed banks to spread the MTM losses on the bond portfolio over 4 quarters. So, are Q4 numbers really going to be that scary that the RBI has decided to take heed of bankers and go ahead and provide these relief measures in the last fag end of this quarter?
See, basically, as per the 12th February RBI circular, yes, definitely, because the exact position of various banks I don't have. But that itself is, in my opinion, will be a big amount. And whatever forbearance given for the bond trading in this 4 quarters banks have to make. So that is again a big relief, because if you see the data of December quarter itself, various banks provided roughly around 7,000 crore. And now only means they have to do 25% plus 25% in March. So at least 50% of that amount will come back. And whatever losses are there in the March, that figure is also not known to industry, but whatever is there, only we have to provide 25% of that. So that is a big relief, but NPA part, yes, definitely it will be a big chunk.
All right, and so if I can ask you, when do you expect your bank to return to profitability? Sometime soon this quarter, June quarter probably, with some of the recoveries coming in?
See, June will be good, but again, whatever provisioning is required in other cases, what I feel in by December, yes, definitely the bank will come back into green.
Okay, so we leave it at that. Thanks for joining us and giving us your perspective on the ongoing issue. But moving on, Tata Motors may actually stand to gain from the ongoing trade war between the US and China, says Nomura. The brokerage house says Jaguar Land Rover, which already locally manufactures in China, can make the most of the American luxury cars getting expensive after the Asian nation imposed higher trade tariffs on imported automobiles. We have Yatin Mehta, who is joining us with more details. Yatin, over to you.
Well, Agam, we have Nomura, which has come out with a note when it comes to the impact of the US-China ongoing trade war. Now, what Nomura believes that since Tata Motors has a plant which manufactures Jaguar Land Rover models in China, they will be insulated from the trade war. In fact, they will be in a sweet spot, since US exports nearly $10 billion worth of automobiles in China, out of which roughly 1/4 is relating to the luxury cars. Now, Nomura says in its reports that US exports to China are at close to 240,000 vehicles per annum. This will possibly dent German luxury automakers, the likes of Daimler, General Motors, Ford, and will be a boost for Tata Motors. In fact, they say that Mercedes-Benz, BMW, Audi, Porsche will be impacted by this trade war. And also, moving forward, they anticipate that the US exports to China will fall by nearly 50%. And since Tata Motors, cars are manufactured in China, they will be relatively insulated to this particular trade war. In fact, the pricing could improve, and not only that, the overall demand would move as the US cars, especially the luxury segment, will be becoming expensive. So on the back of that, we have Tata Motors, which is gaining as much as 4.5% last time I checked, on the back of the possible benefits coming out of this US-China trade war.
All right, Yatin, thank you very much for bringing us those details. Tata Motors, one of the top stocks on the Nifty index. But with that, it's a wrap on this edition of Trendspotting. Up next is Hot Money. Stay tuned to Bloomberg Live.